V for audio video, just to make sure that everything is coming through. Excellent. Thank you so much. I'm excited to be back on and helping y'all out today. We're going to do a little new webinar, and so figured I wanted to hop on and do it. So we have a lot of content we're going to go through tonight, okay? And I'm going to take something that people tend to have a habit of making really complex. I'm going to try to make it simple, break it out, make it complex, come back and make it simple again, okay? Just to help you understand the details of how it all works. For those of you who don't know me, my name is Daryl Martin. I'm with apexinvesting.com, and this is the Nadex application and strategy webinar series. First thing we do when we start a webinar is the same thing as always, is the important disclosures. There is risk when you trade. Make sure you know what you're doing before you do anything, okay? And this is not a solicitation to buy or sell any future Forex, swap, security, etc. It's all that fun stuff. And this is unique information presented by apexinvesting.com. Give you all a chance to look over that, take it seriously. A lot of people go out there and they act like this doesn't mean anything. It does. There is risk. Anybody who's traded for more than 30 seconds knows that. And so it's just an important reminder. All right, so first thing, we're talking about Nadex tonight. I'm not going to go into who Nadex is. They're awesome. I love them. I've been trading them for a long time. But if you don't know, you need to hop over to nadex.com. You need to click on their platform, click on demo, and get a demo account set up. And when you're ready, move forward and get a live account as well. Okay, it's very simple. It's very easy. It's available to citizens all over the world in multiple countries. The countries are listed on their sign-up page. But again, that's Nadex.com, the North American Derivatives Exchange in Chicago. Who is Apex? So my name is Daryl. Like I said, I'm with Apex. Apex is a community of traders. We have a real simple motto: real traders helping real traders. We've all improved the result of being part of Apex, myself included. We're not a follow the guru company. I mean, I am out there to help questions all I can, but you'll notice if you're part of our forums or in our rooms that all different traders are leading. So we're about helping you become your own guru, all right? Membership is free. Education is free. We have step-by-step courses for binary spreads, futures, Forex, strategies, systems. We have a news calendar that you're able to access for free when you log into apexinvesting.com. We have Nadex binary and Nadex spread scanners, which make things so much simpler. So I'm going to explain some confusing things today, but I'm also going to show you how to make it really, really simple, and it's not going to cost you anything because the scanners are free, okay? We have deviation levels, and we show you how to get access to underlying data platforms. We have over 19,000 members now, and we just keep growing because people enjoy it, and they tell others. So I hope you do the same thing. If you have any questions, you can use the live chat, the forum. You can submit a help desk ticket. We have multiple ways for you to get a hold of us, from those basic questions to really advanced questions. We'd like to help you in any way that we can. So, who am I? Some people ask, who's Daryl? Maybe you haven't heard of me, maybe you have. Either way, I'm a trader is what it comes right down to. I decided a long time ago I wanted to become the Nadex trading expert. I love the product. I started off trading options and futures, found out about Nadex, I don't know, 4 or 5, maybe more years ago than that, and dove into it, noticed there wasn't really any education at all on the product, and decided just to dive into it. This part of this needs some work. Anyways, we have a free membership website. We have 20,000 active, almost 20,000 active traders. I'm very excited about that. We've been working with Nadex for a little over 4 years. I've been exposed to commodities all my life, just growing up on farms and ranches. And, I've traded obviously on all different exchanges all over the world. And I've helped author multiple books and radio shows, magazines. We put out 5 to 10 different pieces of educational content a week. I've helped hedge funds work on systems. I've headed up research for arbitrage desk. I've done all sorts of fun things like that. And it's done a lot of unique opportunities, and that's without a finance degree. I don't want to say self-taught because I have had access to hedge fund traders, market movers, market makers that have helped me out. But, I went out there and did it. It wasn't because of a college degree. You don't need a college degree to trade. So I have several of them, and they don't do anything for me in trading, okay? And, I work on what's called diagnostic trading. I try to look at how other traders look at the market. So fundamental traders, look at news and fundamentals on stocks and all that fun stuff, government announcements. Technical traders, they're looking at price action and volume and support and resistance and moving averages, basically anything you can draw on a chart. Statistical traders are looking at actual expected moves and how often something happens. Seasonal traders are looking at how often something happens on a cycle, like whether it be certain times of the day or whether it be certain times of the month, or, like the 1st and the 15th of the month is a seasonal cycle of when people get paid. And so therefore a lot of money comes out of paychecks into 401ks and then to mutual funds, which goes into stocks, and therefore most of the gains on the Dow can all be accounted for in just a few days around that common payday. That's a seasonal cycle, things that can help. So I like to look at how other traders look at the market, and that helps me be a step ahead versus trying to react to just what I see. I designed a lot of trading tools. I give those away for free, tons of those tools away for free. Some of them, of course, we have different memberships for, but most of the tools are free. And I have day trades, long-term dynamic positions, arbitrage trades, just all different types of trading strategies out there. And the biggest thing is I'm about combining probability, risk management, and profit potential, but doing that with step-by-step actions that help you. And I go into, like I said, that risk-reward, advantages, disadvantages, Greek effect, which we're going to talk about today, margin and systematic usage, all those things that help you as a trader. But what I've also learned is that there's really a lot of complex things out there, and most of it doesn't matter. So I want to try to help break down a lot of that complexity and help you see, focus on what is going to help you. So we'll talk about some new terms today. And if you want to learn more, you can follow us at Apex Investing. You can hop on there right now. Go to facebook.com/Apex Investing. Like I said, we put out articles, webinars, we announce live webinars, recorded webinars, all that. We post all of them right there on that site. So definitely go check that out. Just click follow, and if you click on the like button, you can say, hey, notify me when they make a notification. Otherwise, unless you go to the page, most of the time you don't see stuff that pops up. So make sure you hop on there, follow that, and be glad to help you out. Now let's get going with today's, or rather tonight's topic. Nadex spread Greeks made simple. So that's the whole goal, is to talk about this complex world of Greeks, where people like to show you really confusing charts that have nothing to do with you making a decision in the next 5 seconds. I want to make it really simple for you. I'm going to talk about basic options because I'm surprised that I've learned how many people trade Nadex, they don't know what an option is, just a normal vanilla option. So I'm going to lay out what just a basic option is, and with some practical terms. We'll talk about moneyness and what that means, and make sure some views are corrected on that, because you may have heard different things. I've got a lot of conflicting questions. I want to help out with that. We'll talk about some big words like intrinsic and extrinsic value, and help you understand they're really not that complicated. And of course, most importantly, we're going to help you take that practical application versus the academia to help you pick the right spread when you want to trade. Now, if you don't understand the basics of a Nadex spread, you're going to be a little confused, because this is about what makes the price of a spread move. We do have a 30-minute webinar I did for Money Show this week, where I went over just the basics of spreads. In 30 minutes, it'll catch you up really fast over on that Facebook page, okay? I'm not going to spend a lot of time on that tonight, because otherwise this webinar, it could go for 12 hours. And I know y'all want to get on, y'all want to get off, y'all want to go spend time with your family. But we have like a whole spread, step-by-step course that's absolutely free over on our website, okay? But this is a webinar where I've done pieces of this. I've even done radio shows focused on this, but it's been a while since I've done a Greek webinar. So like, why don't you teach the Greeks? And I'm like, well, I can teach anything you want to know about them, but let's focus on what you need to know about them. And so that's what tonight is about. Now, you're going to see this slide over and over and over again. Okay, I'm going to keep bringing this slide up, and this is what understanding a spread, a Nadex spread, really boils down to. It's understanding where is the underlying market. Okay, so I'll just grab a chart here. I have one up. So it doesn't matter what this is. Okay, it doesn't matter if this is the yen or gold or oil or the S&P or what it is. Okay, grabbing and looking at where's the underlying market. So FX, commodity, indice, doesn't matter what it is. And where is it at in relation to the bid offer of the spread? Okay, well, what does that mean? Well, let's say, if you guys get down this one slide that I'm going to show you over and over again, you will become masters of spreads. Okay? So let's say that we're looking at right here. This happens to be the US yen. And let me just try to stretch it out a little bit for you. And let's say this is a spread. And let's say when you buy it, you're buying it up here at, say, 109, we'll say 35, but the US dollar yen is priced at 109, say 25. Okay? So 109.35 is where, say, the buy price, the offer price is. Okay? The yen itself, now that's to buy that spread. The yen itself is sitting at, say, 109, 25. And then the floor and the ceiling are down here at, 109 to, we'll say 109.75 for fun. Okay? I'm just making up a spread right now. Doesn't really matter. What does matter is that you understand the whole thing that you need to grasp to understand spreads and understand which spread to pick comes down to understanding, okay, where the underlying market is, this orange line, in relation to where the bid and offer of the spread is, this pink line, and in relation to the floor and the ceiling. When you understand, one, that they're not all the same, okay, there's a floor, there's a ceiling, there's a bid and offer of the spread, and then there's the actual bid offer of the underlying market itself. On Nadex, you'll see that term as the indicative index, okay? When you understand how the price of the spread reacts based on where the underlying market is, whether it's right at the ceiling or right at the floor or right in the middle. So maybe it's, maybe the underlying market is right here at the floor. Maybe the underlying market's right in the middle of the spread. Maybe it's at the top of the spread. Maybe it's right here. When you understand that the price behaves differently, this bid offer price of the spread behaves differently based on where that underlying market price is in relation to where the spread is, then you start to actually understand how spreads move. And then you'll be able to more aptly choose the correct spread for whatever given have. Okay? So I know that's like a big mouthful, but that's really what all this complexity about Greeks and picking the right spread and understanding how the price moves and all the complex things we're going to say today, they all come down to understanding that this is where the live market is, where's the floor and ceiling in relation to the live market, and where is the floor and ceiling, and where is the underlying market in relation to the bid or offer of the spread, because that's how it reacts differently with that. Okay, that's our lesson for tonight. If you get that down, if you get, oh, those are the things I need to be looking at, then you're going to get a lot out of tonight. And so I'm going to teach you, we're going to go simple, we're going to go complex, because I'm going to give you all the fancy words you're going to hear different places. We're going to go back to simple, okay? So what I'm going to do is I'm going to open up a picture here, and this is one some traders helped me put together last night. We went together and we grabbed all these contracts that were expiring last night. And this happens to be the euro dollar. Again, don't get caught up in this symbol. Who cares what the symbol is on the right? It doesn't matter. It doesn't matter what the symbol is. They all work the same way. Okay? Now, what we want to look at right here is where is what did we just say on that last slide? Okay? Where is the underlying market, or we could say indicative index, okay? So in relation to the bid and offer of the spread, okay, so if the offer is 1.1226 and the indicative is at 1.218, then there's a difference in price. Okay, 1.18, 1.226. So we have a proximity difference. If you round it off, it's, 1219. There's 7 ticks difference in where this is trading. It's trading 7 ticks higher. See that plus 7? Because the indicative market is 7 ticks higher than the buy price of the spread. Okay? And where is it at in relation to the floor or ceiling? Well, the floor is 1.2220. The market is actually under that. It's at 1.219 if you round it. Okay, so it's underneath the floor. See that? Underneath the floor. So, understanding that, it's like, okay, well, that means that there's all premium value. Notice this premium, this thing we call time value, premium value, theta, all the fun words we can give it, okay, is the same as the risk. So it's all time value. It has to move into it before that changes. And so this seems really complex when you look at it to begin with. But you'll start noticing things as we move forward, okay, on this webinar, such as you'll notice, let's look at these 2 spreads right here. All right, if we look at them, then let's see here, get my highlighter pen turned on. Spotlight, there we go. So if we look right here, you can see these are these same spreads, 1.0970 to 1.1220, 1.0970 to 1.1220. We can see something real simple. This one right here versus this one right here, what's going on? Well, we have different risk and reward on the trades, but they're the exact same spread. Well, one has quite a bit more time until expiration. This one has $15 of premium. This one has $4 of premium. One expires in 4 hours, one expires in 20 hours. So with more time is more premium. Okay? So there's all these little things, and I mean, we can go down and literally compare how all this works. And we can see how the price changes over time, not only within the same ladder, but taking pictures. So I took all these pictures, and we'll go back through, and we'll try to, go on it step by step. So one of the things you can't see on the Nadex platform is you can't see proximity. You can't see premium. You have to do the math. So what I want to help you see is how simple this is, that you don't have to be a math wizard. You don't need a degree in finance. It's all there done for you, but I want you to understand where it comes from. Okay? So this is actually feeding the live Nadex instruments right here for you. All right, so understanding where the underlying markets is, and like I said, this is just a picture. It's not a website or anything, just a picture right there. You can go over and you can check out the scanner yourself. But where's the underlying market in relation to the bid and offer? Okay, and in relation to the floor and ceiling. So there's how to drive, and there's under the hood. Okay, right? So y'all agree to that? Like sometimes you need to know what's under the hood. Sometimes you just need to know how to drive the car. All right. So I'm going to teach you a little bit about what's under the hood. But do you need to know how a transmission works to drive a vehicle? Or do you just need to know how to shift the gear from park to drive or first to second or whatever's required? You didn't know how to shift the gear. You don't have to understand all that. But a lot of people use the big words. It makes them feel good. It makes other people feel good. So I want to help you understand that. All right, so first let's talk about just options. And this is like 2 slides on call options, 2 slides on put options. We're going to move on. But it helps you grasp the idea of the traditional vanilla call option. If you want to buy a house, and this scenario came from something I actually did. If you want to buy a house, and maybe you don't have the money to buy it cash out right at the moment, but you want to buy it, and you don't want the price to go up or the house to be sold out from under you. You want to be able to buy it at the price it's listed at right now. Well, I had a house that I was looking at one point. It was on a lake, about an hour and a half from where I live, and I was thinking about buying it. Didn't have the cash for it at the moment, and figured, hey, this could go up in value, or somebody could buy it out from under me. The guy talked about a couple upgrades he wanted to do if nobody did buy it, and I was like, well, how about this? How about you give me 90 days or 6 months, whatever we put in the contract there. I'll give you $1,000 or $2,000 or whatever we agreed to, okay? And you can't sell it to anybody except me, but if I don't come and buy it from you by the end of that time, you get to keep my $1,000 or $2,000. that I gave you for the house, for the option, and then I could go give me 100 grand. Okay. He's like, hey, that's great. I get some cash no matter what. And I didn't buy the house. Option expired. Lost my money. Now, in reality, the reason I didn't buy the house is because there was a massive forest fire, and it burned down the house and all the trees and everything else around there. So I came out way ahead by buying that. It was a safe, or, you know, I mean, not necessarily safe because I was still risking money, but it was a defined risk way for me to trade. Now, if I exercise that right, the seller's going to keep the 1,000. I pay 100,000. Even if the house is worth 200 grand, because all of a sudden all these things got developed around it and it's worth a ton of money, I could go and I could sell the house for $200,000 with the right of that option and let somebody else get it. Okay? That $1,000 is extrinsic value. Okay? The $100,000 is the intrinsic, the actual value of the house. If the housing market dropped or burned down or whatever, and it's only worth $75,000, and I don't exercise my right to do that option, seller keeps $1,000, but I don't lose 25 grand or 75 grand or 100 grand or whatever went down in value. I could also just resell the option, and that's what most of us option traders do. We buy options and we resell options. So if I resold my option and I bought it, someone else could buy the house, you know, with that $1,000 before the option expires. So I don't have to pay out 100 grand for the house, but 3 months later it's worth 125 grand. I go sell that option to somebody for $25,500, and they have the ability to go buy the house for 100 grand, and they think it's going to go 200 grand in the next few months, and so on and so forth. That's a call option. It happens on stocks constantly. Okay. So call options, when you have the right to call it away from somebody, if you're buying the call option. And the way I would tell this, think like you're picking up the phone, you're calling somebody. Okay, calling up. So the strike price is the right you had to buy it at, and the expiration date is 6 months away from today. Premium paid with $1,000. The premium is made of two things: intrinsic value and extrinsic value. Well, the house was worth 100 grand, and you bought the right to buy it at 100 grand. Then the $1,000 you paid was pure extrinsic value, just like that option we looked at a second ago, where it wasn't even inside or above the floor. It was pure time value. The premium was pure time value. Okay. But if you sold it to somebody else for $25,500, when the house went up in value to 125 grand, you received $25,000 in intrinsic value and 500 in extrinsic value. And that extrinsic value is what throws everybody off when they're looking at options. Now, maybe you've never done a call on a house, but I bet you've done a put option on a house or a car. If you have a house worth 100 grand and you buy insurance for it, homeowners insurance, or even home renters insurance, then the put option is there to reimburse you, ideally for the full cost of the house, 100 grand, plus probably additional things. But let's just say it covers up to $100,000, the strike price. If it burns down to the ground, it costs you $1,000 for the insurance. So if the house burns down, you're out $1,000, but you get back 100 grand, so you only lost the premium you paid instead of the entire house. All right, so you have $99,000 in your pocket, but you're out, because you're out 1,000, right? They gave you 100 grand, you gave them 1,000, you're net 99,000, and no house. Now, if you bought an insurance policy when the house was worth 100 grand, and that had a strike price of $90,000, only $90,000 given back to you if the house is burned down. Well, that would be like having a $10,000 deductible. So you pay your premium plus you pay your deductible if you actually file a claim. Well, that's when the option's a little further from where the market is, where the value of the market 100,000, but the option's priced right now at 90,000. Okay, for coverage. So if the house burned down to the ground, you'd get your 90 grand, but you'd be out 10 grand, but you only paid 200 bucks in premium this time because you had a $10,000 deductible. So it had to, you paid less, but you also got less for what you paid. That's the same thing when you're trading these spread options. Sometimes you get really cheap ones, but it doesn't move as far as fast. Okay? The premium was cheaper because the put option was out of the money. So there's a deductible amount you're not going to be reimbursed for. Well, that also happens in spread options in a similar fashion, where it's out of the money and the market has to move further. So if you have homeowners insurance and it burns down, you can get reimbursed from the home burning down. If you have a put option, insurance on a stock going down, then you can get reimbursed for the stock burning down. You can even use spread options to hedge. I have a simple video called The Ultimate Hedge Strategy. You can look that up. It's on the archives on Nadex and our Facebook page and all that. And it talks about how to use these to hedge your futures and Forex trades, your day trades. If you're a future and Forex trader and you want to know how to hedge them on a daily basis, Nadex spreads are the ultimate option for that because they give you maximum coverage because they expire same day. So that, again, is just a quick, that's a fast overview of just what is an option. And why am I explaining options to you? One, I want you to understand you're trading options. Some people get in this and they think they're trading Forex. They think they're trading futures. Well, that's fine, and you're trading a derivative of them. So they're going to be priced a little differently. They're going to move a little differently. Okay? It doesn't have to be real complex. It can come down to where is the underlying market at? Right? Where is the underlying market at in relation to where is the bid and offer of the spread? And where is the floor and ceiling of the spread? And that's that one definition I'm just going to keep coming back to over and over for you. As soon as you understand that this is what's going to be your aha, I get it moment, then you'll love spreads. I love spreads but you have to get that it's about where's the underlying market in relation to where the buy or sell price of that spread is, and in relation to the floor or ceiling of where that spread is. And I draw it like a box because it starts at a certain time, it expires at a certain time, and it has a ceiling and it has a floor. Okay? So again, coming back to that over and over again. So now let's go into another topic with this. It's a spread. And some people liken the spreads to being debit spreads. And they are very similar in how they work. What I've found is if you go and compare a spread on Nadex to a vanilla call with the same strike, as a floor, or a vanilla put as the same strike as a ceiling, on a Friday expiration on CME for, say, the ES, the S&P 500, the pricing is almost exactly the same within dollars. So they actually act a lot more like just a vanilla call or put because they're so short-term in expiration. They act a lot less like traditional spread ideology, okay? So it's more like a vanilla call and put, like I just explained. Yes, the graph looks like a debit and credit spread, and we can pull out all those fancy graphs. There's a capped risk, capped reward. You're trading in between, okay? But bottom line is they move just like a vanilla call or put because they only have less than 24 hours to expiration, okay? That means we have to keep them a lot simpler. Now, a lot of people go, well, are they credit spreads or are they debit spreads? Well, there's really no such thing as a credit spread because whenever you trade a spread, in all actuality, you are debited for the risk of the trade. I don't care where you're trading it, okay? You're not given a credit. What it means is debit and credit refer to the premium of the extrinsic value being on your side with time and implied volatility, or against you with time and implied volatility. So if the premium is on your side, meaning you make money as implied volatility drops or as time passes, it's a credit spread. If you lose money if price stays the same from where you entered, then it's a debit spread, okay? So if time is working for you, it's a credit spread. If time is working against you, it's a debit spread. They're not all debit spreads, okay? And again, that's referring to how is the IV implied volatility, which we're going to talk about that, and how is time working for or against you. Now, let's talk about moneyness. And I guess this is a fire hose of a webinar, okay? But it's none of these concepts are rocket science, as I've shown you so far, okay? There should be nothing that's like, it's just like, well, I'm trying to figure out. I'm just filling up your vocabulary right now. But it all comes down to that one simple slide. So there are near the market spreads. There's ITS in the spread, there's DITS deep in the spread, there's OTS out of the spread, and there's ATM at the money or strike. So let's define what those are, make that as easy as possible. All right, so the easiest spread you can trade is what's called a near the market spread. There's no such thing as a null spread because it's not going to remain without premium very long. Like once it moves, it's going to start having premium. So what is a near the market spread? A near the market spread just means it doesn't matter if it's in the middle of the spread. It doesn't matter if it's near the floor or the ceiling of the spread. It means that the underlying market is right near where the bidder offer of the spread is trading. Okay? So it's right where the bidder offer is trading. So if I go back to that screenshot earlier, just to show you some examples, an easy way to show you examples without doing a whole bunch of math. These little red things say NTM, near the market. So that just means that, you know, the market's at 1218, it's at 1217. It's like a tick or two off, 2 ticks away. Okay, so it's saying, hey, this is a near the market spread. Some of these are, you know, quite a bit of ways. So they don't say that they're near the market. But the ones that are near the market, okay, that's an MTM spread. What is an MTM spread good for? Well, there's no technically extrinsic value. I mean, there may be a couple dollars, but not that much. But again, that doesn't necessarily last because the spread moves closer to the floor or closer to the ceiling, or as implied volatility changes, then you could actually get some premium. So just understand it's not like an always thing, but it starts off as that near the market spread. Now, again, this is when the underlying market, and I'm trying to use the visuals to help you so you don't just get caught up in, you know, the paragraphs. So the underlying market is very close to where the bid or offer of the spread, what it costs to buy or sell the spread, is right near where the underlying market is. Okay, that's a near the market spread. And we're going to talk about delta in a minute, but that basically means the delta is very close to, if not at 100, which means the spread will move more like the underlying market. Okay? So when you got a near the market spread, it's going to move more in a tick for tick basis at almost like if it moves $1, the other one's going to move pretty close to $1 if it starts out near the market. Okay? Now, if it's way far away, like 17 ticks away, right there, like I said, that one's not going to move as fast as the one that's only 1 tick away from where the market is. So when you understand that relation of where the underlying market is in relation to the bidder offer of the spread, you'll start to understand how the spread moves in price. So if you want a trade and you want to go, hey, I'm trading on a chart and I want to go in and grab 10 or 15 ticks or whatever, and you're really trying to mirror the underlying market, you're going to want to near the market spread. Now, another big tip for you is the wider the distance between the floor and the ceiling, and the more near market the spread is, the more it's going to mirror the market for a longer period of time. Your goal is not for it to buy it and it go above the floor or go below the ceiling, because then you stop making money, okay? So, I mean, you still profit, that's always a great thing, but if you want to make as much as possible, if you expect large moves or even small moves, you want to near the market spread with a lot of room, okay? You don't need you can get the 2-hour ones, but understand as they get close to the floor ceiling, they're going to move slower. But if it's a really wide spread, they'll stay more in that center of the spread, okay? The bid and offer in the underlying market are going to stay closer to that center of the spread, and you're going to actually, and I mean like in the middle 70%, then it'll move more like the underlying market. So if you expect large moves, choose a wide spread. You know, if you don't expect a large move and you're just going for 10 or 20 ticks, you may choose a 2-hour spread. Maybe it's going into scalp, so you don't need it. But I'm just telling you, the wider they are, and the more near the market they are, the faster they will move. Okay, it's called delta, it's effective, all this other fun stuff we're going to talk about. But that's what you need to know. That's the English of the Greek, okay? So I took 2 years of Greek. Doesn't help me, okay? Literally took Koine Greek. But the reality is English is what you need to know, or whatever language you speak in. But it just needs to make whatever your natural native language is, that's what you need to understand. Understand the underlying does not have to be in the center. I mean, it could be right near the floor. If the implied volatility is low, or there's not a lot of time till expiration, you can get a near the market spread with very little risk. These are really good for pretty much any market condition where you're trying to grab a directional move, small or large, okay? A near the market spread. Now, hopefully everybody has near the market spreads down. It just means, one, that the underlying market is close to where the bidder offer is, okay? And you can do the math yourself by looking at the bidder offer and comparing that to the indicative, or you can click the near the market button on the scanner and it'll instantly show you just those spreads, okay? Now, There's also in the spread and deep in the spread, which could also be, by the way, a near the market spread. All right. With the spread, with the Nadex spread that cash settles, it's not a binary. It doesn't have just one strike. In the money and deep in the money don't really mean anything to you as a Nadex spread trader. Okay? And I used to use the terms in the money and deep in the money, but after trading thousands of these contracts over years and years and years, I've learned that that really doesn't apply. What really matters is the in the spread or deep in the spread. In the spread is it's a really simple definition, okay? It simply means that the underlying market, this orange line right here, is somewhere between the floor and the ceiling, anywhere in between there, is a spread that is in the spread. The underlying market is in the spread. Doesn't do you a whole lot of good. It just sort of lets you know where's that in relation to the floor and the ceiling. Okay? All right. Now, one thing to understand, and this is starting to get into some of the technicals for you, is if the spread is somewhere in the underlying market is somewhere in between the floor and ceiling of the spread is going to move somewhere between what's called a delta of 50 to 100. What is that? The delta, Greeks. We're getting that in a second. It means that the spread will move somewhere between 50% and 100% of the underlying market. So the underlying market was moving, right here, and if it was moving down, maybe the market moves 10 ticks and your spread only moves 5. Okay, or maybe it moves 10 ticks because it's right in the center there, and your spread moves 10 for 10. That's 100 delta. 50 delta would be where the spread just moves 5 ticks if the underlying market moves 10 ticks. So it's going to be 50, 50, and 100. And I'll give you some more examples of this, but delta is just about a relation of how fast that spread price moves. And it's always going to be between 50 and 100 if the underlying market is in between the floor and the ceiling. Okay? And the closer it is to near the market, the faster it's going to move. So, pop quiz for you, real quick. Okay? Let's say we were looking at this spread with that as the underlying market, and the offer price is here with this distance. Is it going to be moving at 100 delta? Is it going to be moving at the same speed? No, it will not. It'll be moving at a slower speed, maybe closer to a 50, because it's pretty close to the floor and ceiling, which is where the 50 delta happens at. Okay? And then it gets a little faster as it gets closer to the center. What if we move this up a little bit right here and right there? And do you think that that spread at the bid offer at this point might actually move pretty fast? Yeah, that moved like closer to the actual speed of the underlying market. Okay? So pretty simple, right? So that's, in the spread can range between 50 and 100 speed. And it's important to understand because people get in these trades and they're like, man, the market maker's messing me over, or Nadex has it rigged, or this. They make up all these things because they don't understand what is the bid and offer in relation to where the underlying market is, and where's the underlying market in relation to where the floor and ceiling are, and that impacts how fast or slow the spread moves. Okay? So that one slide I showed you all comes together with this right here. Now there's deep in the spread. Now if I'm buying a spread, okay, and the market's way up there and I buy it right here, okay, do you think it's going to move tick for tick if the market's already above the ceiling of the spread? So it won't. It'll have premium in it, okay? Will it move at all, Zachary? Yes, that's a good question. So yes, it will move. Okay? It'll move slower though. It'll move slower than a delta of 50. So if price moves, it will actually move, but it may move at 40 or 30 or 20 or 10% of the underlying market because it's that extrinsic value. And people go, I can't grasp that. Okay, we're going to help you grasp it. But one way to help you grasp it is there's sort of a time value in there too. So as time passes, it'll also move. Okay, you'll be collecting more of that, what's called collecting premium. Now, you can collect premium whether or not it's deep in the spread. It doesn't have to be the floor ceiling. It can be anywhere as long as it's positive premium. So let me help you try to wrap your mind around this, because I know this is one of the harder concepts. And let's look at this screenshot again. I'm just referring to it because it makes, we don't have to spend here doing an hour doing math. If we look at a contract and the market is, let's see here, quoting at 1217, okay? And the floor is 1220, and we sold that spread at 1221. There is $1 of premium. There's not a lot there, okay? Not a lot to make you get real excited about it, but it's $1 of value. It's just time value. And over time, that dollar will dissipate. How do I know that? Well, just look at this. This is the exact same contract, 1220 to 1470. There's $3 of premium, and this one expires an hour later. Or we can look at one that expires 18 hours later than the first one, and the floor is 1220. The market, 1217, is below 1220, and it's priced at 14 ticks above. 1, 2, 3, 4. 14 ticks above the floor. And there's 14 ticks of premium. So that's premium over time. More time there is, more premium there is. Does it cost more to pay for a year of insurance or a month of insurance? I know it's an easy question, but answering does help it get locked in. What costs you more, a year of insurance or a month of insurance on your car? A year. I know, like I said, I know it's really obvious. So there you go, a year. Those who answer are going to get this better, okay? So what's going to cost you more in premium? A contract that expires in 19 hours or one that expires in 1 hour? If say the floor is the same on all of them. The one that expires in 19 hours. Okay, this one's deep in the money, meaning the market is underneath the floor. So there's premium in there. So why would you get more? Well, because you're taking on risk longer, because look at that risk reward. The risk is higher than these other trades, so you're going to get compensated for taking on that additional risk longer. The other person, they're going to pay the insurance, so they're going to pay over here 17 bucks, okay? So they can possibly make a whole bunch, or shield their car if it crashes, or shield their euro-dollar FX trade if they went long and the euro-dollar going short, or vice versa, okay? So the point I want you to get is just, again, that deep in the spread, it's going to move slower. As implied volatility drops, if you're deep in the spread, which always means, always, deep in the spread, means that the underlying market is greater than the ceiling when you buy, meaning it's already above the ceiling, or it's lower than the floor when you sell. Okay? So if implied volatility drops, I'll talk about that big word in a little bit, or time passes or price moves, you'll make money, but just understand that it won't move as fast. Okay? Hopefully that's clicking with everybody. Now, what about at the money? Now, this is something that I've seen some people sort of mess up on. There are two at the money strikes because it's a spread. It has two strikes, right? You don't just have one. You don't just have a call. So you have two at the money strikes because your delta is 100. It's right in the center. Okay, that's where your delta is 100 at. So you have a strike here at the ceiling and a strike here at the floor. If the underlying market is at the floor, it's at the money. If the underlying market is at the ceiling, it's at the money. Okay, that just means at the strike. That means the underlying market, in this case the US yen or gold or S&P or oil or whatever you like to trade, is right at the floor or ceiling. Now that could be a credit or a debit spread. So let's say it's at the money right here and you're buying. Okay, so you're buying, you want the market to go up. Is that a debit? Is time working for you or against you? If you bought it above the market, and I'm hoping you get this, if you buy higher than where the underlying market's trading, is time working for you or against you? It's working against you. Perfect. Okay, what if you sold? What if you sold higher than where the market's already at? Is time working for you or against you? Perfect, it's working for you, right? Because you sold higher. It's always good to sell things higher than what they cost, right? It's always good to buy things for lower than what they cost. but it's not necessarily going to buy things for higher or sell things lower unless you do that on purpose. So just understand, when it's at the money, the market will move at basically, a delta of 50, and the risk is your premium. There's no intrinsic risk. There's extrinsic risk. Okay? So it's going to move out from its delta of 50. It'll move faster as it goes a little close to that center. It'll move slower as it moves away from it. There's also out of the spread. Out of the spread and deep out of the money. Okay? Out of the money, deep out of the money, those don't really mean anything to you. Just out of the spread. There's no deep out of the, either you're out or you're not out of the spread. Okay? And what that means is real simple. If I was a buyer, okay, and it's up here, that's out of the spread. It doesn't matter how far out of the spread, it's out of the spread. This is where people get in trouble. They see, oh, $10 risk, and they don't understand that the underlying market is 30 ticks away from where that floor is and from where the offer price is. And so it has to move really far before it gets to that delta of 50, 60, 70, 80, 90, 100. So it moves so slow, and they wonder why they don't make any money trading spreads. Okay? Or it's down here, and it's, they're selling, and they're like, man, it moved down. Or, maybe they went and they sold one which way down here. I guarantee you, some of y'all done it, right? You went here, you sold some spread that was way down here, but it's only $3 risk, but you didn't realize it had to move 40 ticks before you could actually start really making much of anything. It's going to move like a delta of 10. So if it moves like 10 ticks, it may move a tick. It's going to have to move 30 ticks to pass your bid offer, right? So all back to where's the underlying market in relation to the floor and ceiling of the spread, okay? So don't be fooled by the risk. You need a very trending market or a market that's going to go really far one way, like a straddle before a major news announcement if you're going to do that, okay? It all boils down to where's the underlying market in relation to the bid and offer of the spread, in relation to the floor and ceiling of the spread, and how the spread price reacts to those various points. As you understand how the spread will move based on where the underlying market is in relation to the floor and ceiling, then all of a sudden the spread price starts to make sense and you can choose the right spread for the right strategy. Okay? So again, there's Greeks and there's English. Greeks are a fancy way to say a math formula to measure price movement, but they're not the actual price movement. I've taught Greek, like I said, a lot of times on radio shows, webinars, things like that, and I wanted to clear a few things up. These are day options. They last a day, a week at most of the binaries. We'll talk about that next week, okay? But you don't have to be a rocket scientist. This is elementary. It's pretty simple. They only last one day. So I'm going to show you the Greeks real quick for academia's sake, and we could spend a week going over every Greek in so many different ways, but at the end of the day, it's just how do I know which spread to choose, okay? By the way, there's not just 5 Greeks. There's delta, gamma, theta, rho, vega, vana, charm, beta, vera, color, speed, ultima, zoma, duo, delta, duo, gamma, future, and there's more Greeks. There's more than 5. So you can make this get really, really, really complex, okay? But we don't need to make it complex. Vega, it's actually a constellation. It's not a Greek, and it measures implied volatility and how much the price of the option will change if the implied volatility changes. What is this word implied volatility? You've probably heard it a lot. It means one simple thing. Implied means expected. Volatility means movement. So if the expected movement in an option changes, it'll change the price by so many cents for every 1% change in that IV. What do you think might be something that would change implied volatility? There's 2 major things that are really easy. What do you think would change the expected movement for any market? News. Yep, news is one of those things. So expectation coming out, the market's going to keep moving. And the other one is actually something that's already happened. The market's moving a lot out of nowhere, right? So that's going to change it. Well, it might keep moving a whole lot. So implied volatility could go up based on current volatility or based on something that's going to come out. We got theta, which is how much the price of an option will change with how time decays. This is like one of the most useless things in spread trading because it's a measurement of one day's time value. Well, there's only one day or less in all spreads. So all you need to know is what is the premium, which is the extrinsic value or the price minus where the underlying market is up to the floor ceiling, and that's your theta for the whole day. Okay? You got delta. That's how we talked about that a lot already, how much the price changes for a $1, by the way, for a $1 move in the underlying. So if the market moves a point, does it move 50 cents? Does it move, half a point? Does it move 1 point? Does it move a tenth of a point? And then gamma. How much the delta will change for every $1 move in the underlying. So it's the delta of the delta. So let's try to make these make a sense in as short a time as possible for you. Let's see, we got that one down. All right. So first we're going to talk is Vega. Vega is the most important Greek of all of them. It's more powerful. It can override delta, gamma, theta. I was in the flash crash going short on the S&Ps and had some call options that went profitable when the market crashed on that flash crash because the implied volatility went so high. It's more powerful than direction of movement and time. So there can be more premium in a trade even as time passes if implied volatility rises. Okay? And let me show you just a real simple example. This is Apple. So everybody's probably heard of Apple or has a product of Apple. And these are earnings announcements right here. This is a little chart of the price of Apple. And this is the implied volatility measurement of the options. Just the value they extract. One thing I want you to notice is every time there's an earnings announcement, implied volatility goes up. And then whether the market gaps huge or whether it barely moves, the implied volatility drops. Boom, 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 every time. Okay, it's called an implied volatility bubble and IV crush. So before a major news announcement, like the Fed funds rate, implied volatility is going to go way up. Whether or not there's a lot of movement, the options are going to go way down in value, simply because they are pumped with expected movement. Okay, now that whatever expected movement has happened, now there's no more big expected movement because there's not another FOMC happening in the next 30 minutes, so boom, it's gone. That's what inflates the options. And if you look at the news trading plan on Apex, you'll see that we actually take advantage of that implied volatility and collect the premium on most news announcements. So Vega is the measure of price change of IV. IV means implied volatility. Implied means expected. Volatility means movement. As it rises, there'll be more premium in the spread. As it falls, there'll be less premium. We'll obviously have more premium before news. It'll overrule theta and delta and gamma and all that fun stuff. But one of the most important things, it has the least impact the closer you get to expiration. So the shorter time frame to expiration, even with news in there, the lower the impact of IV, because there's less time for it to move. Okay? Theta. Theta is time. It's how much value there is until time value there is until an option expires. It's the air in the tire. It's only a one-day spread. So whatever the premium, the extrinsic value premium is, that's it. And theta drops over time. It doesn't just drop in the last 5 minutes. You don't need any complex graphs. Just look at a price ladder. Okay? Exact same contracts. 1120, 1120, and you can see there's more or less. There's $5 a premium, $1 premium. Here's the 11 and the 3s. There's $7 a negative premium, $18 a premium. Okay? Or you're on that one, you're actually getting $15 a premium. This one, you're paying $3 a premium because there's more time. It's just the time value. You're paying for that insurance, or you're collecting that insurance. Like I said, insurance costs more for a year than it does for a month. Okay? So it's going to make it move a little slower if it has a lot of premium, if it has a lot of theta. If it has less premium and very little proximity, it's going to move faster because there's not a lot of premium in it. It's more of just matching the underlying market. It's near the market. Okay? Let's see here. We got delta. We have gamma. Okay, gamma, like I said, is the delta of the delta. If the delta is 50 and the gamma is 10, then when the underlying market moves $1, then the delta will now be 60. If it moves another $1, the delta will be 70. If it moves another $1, the delta will be 80. Okay? So you can be aware of all these Greeks, but just be aware that theta is the price of your gamma. So the more time there's till expiration, the slower it moves. The less time there's till expiration, the gamma, the faster it will move and become more like the market. So less theta, more gamma. Faster delta gets you to full speed. And again, gamma can be overridden by implied volatility. What does that matter? It doesn't matter. Just understand where the underlying market is in relation to the bid and offer and in relation to the floor and ceiling. The closer it is, the faster it'll move. Rho. Doesn't really matter. It's about how much interest is charged over the course of a year, time value of money. We're talking about one day on an interest rate that's basically 0 or 1 or 2% or whatever it is these days, divided over the course of the entire year for one day. It has little to no impact on a daily expiration. So I don't have to even worry about it. Summary: the less implied volatility, the less time there is to expiration, the closer to the center. Any of the above or all of the above will expedite how fast the spread price moves when you're trading it. It will be trading closer to the price of the underlying market if the underlying market is trading between the floor and ceiling. Okay? It all boils down to this: understanding where the underlying market is in relation to the bid or offer of the spread and in relation to the floor and ceiling of the spread. And how that spread price reacts at those various points will allow you to understand how the spread will move and how to choose the right spread for the right market condition. And again, that big complex sentence is very simple. Where's the underlying market? Where's the spread? What is the buy or sell price of the spread? If I'm buying way above, it's going to move slower. If I'm selling way below, it's going to move slower. Okay? If the spread is nowhere near the market price, it's above or below the floor ceiling, it's going to move slower. If it's in between, then it's going to more mirror the market, especially if it's close to the bid and offer of the underlying market. So if you want to check out the scanner, check that out. It's free, but just look at the premium and proximity. You can do the math on your own. You can subtract the indicative from the bid and the offer. That'll tell you what the proximity is. It's real simple. Just the indicative, basically underlying market minus the bid or offer. Okay. If you know what the premium is, it's if it's deep in the money, or if it's deep in the spread, or if it's out of the spread. Okay. Then what do you do right there? If it's deep in the spread or if it's out of the spread, then it's going to be all extrinsic value. The premium will be all extrinsic premium. Okay? If it's in the spread, the difference between the underlying market and where the bid or offer is will be the extrinsic value on the premium. Okay? So again, proximity, difference between underlying market and the bid or offer at all times. That's the proximity. The closer that is, the faster it will move. The further it is, the slower it will move. And we've went over this over and over again for you. Proximity means buying or selling above the market. Negative proximity means buying or selling below the market. And I was showing that on a chart. You may not even have realized it, but we were talking about what if you bought it above the market? What if you sold it below the market? That difference between those prices, that's proximity. Okay, the closer it is, the faster it moves. We can get all sorts of Greeks up on this, but that's all it means. Okay? And just like you might notice that a binary moves slower once it gets to the 90s. A spread will move slower once it gets closer to the floor, above the floor, or sorry, close to the ceiling or above the ceiling, close to the floor, below the floor. Okay? Premium is that extrinsic value for this purpose. We're defining that as the part of the premium on there. And that's this between the underlying market and the bid offer as long as it's inside the spread. If the underlying market's outside the spread, premium is the entire risk or reward depending upon what direction you're going in. And let's see, so we got that. Without going into a whole lot of examples, negative premium means you're paying for time. Positive premium means you're collecting time. And I'm going to bring you back one more time to, it all boils down to understanding where the underlying market in relation to the bid or offer and in relation to the floor ceiling. When you understand and you start actually paying attention to that simple thing is how far is the bid or offer from the underlying market and where's the underlying market in relation to the floor ceiling, you'll start to get how the spread moves slower when it's further away or above or below those levels. And then you'll start knowing what spread you want for what strategy you want. So demo trade them first. Hop on Nadex.com, go over and grab an account under platform. I believe they have a demo thing. And of course, hop over to apexinvesting.com to get yourself, free education, other webinars that we do throughout the week, access to radio shows and articles and more, and how to get access to charts and platform data and all sorts of fun stuff. And again, if you have questions, live chat, anything like that, you can always go to our help desk. And don't forget to follow us over on Facebook. We'll be glad to help you out. Okay? And I'm going to open it on up to John for questions. It looks like we don't have too many. I only see one that's sort of sitting here. And that was a question about trader spread when you also have a stop loss out there, something that doesn't offer. Check out the scanner. And you might find something that will help you with that. Okay. And how can you trade a spread without having? Hop over on the scanner. You definitely want to check that out. Okay. We can help you out with your exact question. And let me go ahead and just wrap this up. I want to thank you all for coming. We were able to keep that to an hour, which is amazing. I know it's a lot of information. We'll get the recording up on the archive for you on Nadex's site. And, of course, we post everything up on our Facebook site. And, again, I thank you very much for your time today.